All right, welcome to this explainer. Today, we are putting on our senior equity analyst hats and diving right into a rigorous, step-by-step stock valuation of Urban Outfitters. If you've ever found yourself wondering exactly how the pros cut through all that day-to-day market noise to find a stock's true intrinsic value, well, you are in exactly the right place. Let's get right to it. So, our anchor point today is exactly $68.16. That's the price URBN stock closed at in the financial data we're analyzing. I want you to keep this number in the back of your mind because it's going to be our benchmark throughout this entire analysis. Literally, everything we calculate today is going to be held up against this $68.16 market price. Which brings us to the big, fundamental question we need to answer. Is this price a bargain or a trap? I mean, the market is offering us shares at roughly $68. We're going to use cold, hard financial modeling to figure out if that price represents a genuinely undervalued bargain, or if it's just an overvalued trap waiting to catch an unsuspecting investor. Okay, here's our analytical roadmap. We'll look at the URBN challenge, run through absolute, relative, and asset-based valuations, and finally, synthesize our intrinsic value.
Section 1. The URBN challenge. Looking under the hood.
Looking at the filings, you immediately see a really fascinating picture. The data shows an incredibly clean balance sheet with zero debt. Let me repeat that because you don't see it every day. A debt-to-equity ratio of exactly 0. They're pulling in a robust $6.16 billion in trailing 12-month revenue. On top of that, their return on invested capital is sitting at a highly efficient 14.29%, and return on equity is 16.51%. So what you should take away from this right out of the gate is that URBN is a lean, highly profitable engine that literally funds its own growth without having to rely on banks. Moving on to Section 2, absolute valuation. Cash is king. Normally, as equity analysts, we'd kick things off with a dividend discount model, or DDM. It is by far the most direct way to value the cash a company returns to its shareholders. But here's the catch. Our data shows URBN actually has a 0% dividend growth rate over the last 5 years. They just don't pay a regular yield. And since the DDM entirely relies on projecting future dividends, this model simply doesn't work for URBN. So we have to immediately pivot to the absolute gold standard. Free cash flow. So to reverse engineer the discounted cash flow math from our source documents, we're taking 3 specific steps. First, the data gives us a historical 5-year free cash flow compound annual growth rate of 19.99%. We project that forward. Now, the documents don't explicitly hand us the company's cost of capital, so we have to make some sensible analyst assumptions here. We're applying a standard retail weighted average cost of capital of 8 to 10% to discount those future cash flows back to today. Why? Because $1 tomorrow is fundamentally worth less than $1 today, right? Finally, we tack on a conservative terminal growth rate of 2 to 3% to account for all the years beyond our projection.
And when you run that strict discounted cash flow math, the pure free cash flow fair value comes out to just $44.72 per share. This is the intrinsic value of the company based solely on the free cash it's expected to throw off, discounted back to the present day.
Now compare that to our $68.16 market anchor. Ouch. That reveals a severely negative margin of safety at negative 52.41%. In value investing, you obviously want a positive margin of safety. You want to buy the stock for less than it's fundamentally worth. But here, the strict cash flow model is essentially telling us we're overpaying by more than 50%. So if you're only looking at free cash flow, that current market price, it looks like a trap. But wait, if we shift gears from pure cash to accounting earnings, it's a completely different story. If we run our fair value model using their honestly impressive 29.94% 5-year earnings per share growth rate, the fair value jumps way up to $64.70. That brings our margin of safety to just negative 5.35%. This is much, much closer to the current market price, which really suggests that investors out there are pricing the stock based on its strong earnings growth rather than the actual free cash it has available. To round this out, let's look at a residual income framework. This model starts with a current book value and then adds future economic profit, which is just net income minus an equity charge for investor capital. Because their 16.51% ROE so easily beats standard equity costs, it proves URBN is generating real, tangible economic profit above what investors demand. That adds a crucial layer of confidence that those accounting earnings we just talked about aren't just a mirage. Okay, Section 3, Relative Valuation, Peer Comparisons. Quick caveat before we start comparing. We need to state our assumptions. The data we have gives us URBN's multiples, but doesn't actually name their explicit peers. So as analysts, we are assuming a standard basket of publicly traded specialty retail apparel peers. We're going to see how URBN's multiples stack up against what you typically pay across the broader retail industry. Looking at these multiples, URBN is actually super interesting. You've got a forward price to earnings ratio of 12.59, an enterprise value to EBITDA ratio of just 6.99, and a price to sales ratio sitting under 1 at 0.95. Why does this matter? Well, compared to standard retail averages, where you often see PEs up in the mid to high teens, URBN is priced incredibly attractively. Our relative valuation models are heavily suggesting that compared to the broader market, URBN might actually be a bargain. Next up, Section 4, Asset-Based Valuation, the floor. To figure out the net asset value, or NAV, we go straight to the balance sheet. URBN is currently trading at a price-to-book ratio of 2.17. Now remember that zero debt we talked about? Because there's absolutely no debt to subtract from their fair market assets, URBN's raw book values served as an incredibly firm, rock-solid floor for our valuation. Their short-term liquidity is also looking great. They have a current ratio of 1.51, meaning their short-term assets easily cover their short-term liabilities, and a quick ratio of 0.88. Basically, this net asset value acts like a fortress that limits extreme downside risk. Finally, Section 5, Synthesizing Intrinsic Value, the final verdict. This is where all comes together, and man, it reveals a fascinating tension. Look at this. Our pure free cash flow model values the stock at just $44.72, but the earnings per share model points to an intrinsic value of $64.70. And all the while, the actual current market price is sitting slightly higher at $68.16. So there is a really wide discrepancy here between what the pure cash flows are telling us and what the earnings and the market are demanding. So you've essentially got two competing narratives here. The bull case enthusiastically points to that zero-debt balance sheet, the strong 16.51% ROE, and those cheap relative peer multiples. Bulls look at this and see a lean, mean company trading at a massive discount to its sector. But the bear case? The bears are waving a massive red flag at those absolute cash flows, that $44 fair value, warning us that the cash just doesn't support the current premium, and the market is overestimating how long this growth can actually keep up. As analysts, we have to make a call, and we deem the free cash flow and EPS models to be the most reliable indicators of long-term intrinsic value in this scenario. Weighing those out, our final synthesis is that URBN currently trades at a slight to moderate overvaluation. At roughly $68, the stock is basically priced for perfection. It relies entirely on URBN somehow sustaining its nearly 20% historical cash flow growth and that 30% EPS growth, which leaves almost zero margin of safety in a highly competitive apparel market. Which really leaves us with this final, kind of wild thought to chew on. Think about it. URBN has a pristine balance sheet, zero debt, and double-digit returns on invested capital. Yet by strict absolute valuation standards, the math still says it's slightly pricey. If an engine this financially clean is still considered overvalued, what does that say about the sheer unforgiving level of growth the modern market demands from retail companies today? Food for thought, right? Thank you so much for joining me on this Valuation Explainer. Keep analyzing, and I'll see you next time.